Welcome back to ChainFinance. Today, we're diving into a critical topic for every serious trader. It's about understanding order blocks and market structure. These concepts reveal how institutions move markets and why retail traders often get caught on the wrong side. Markets are not random. Price movements are guided by smart money. Institutions leave footprints in the market, and if you can read them, you gain a huge edge. First, let's define market structure. Market structure shows the behavior of price. It identifies highs, lows, and trends. Higher highs and higher lows indicate an uptrend. Lower highs and lower lows indicate a downtrend. Recognizing these patterns is the first step, but trends alone aren't enough. You need to know where institutions place their orders. This is where order blocks come in. Order blocks are areas where big players enter trades. They are typically the last bullish or bearish candle before a strong move. Institutions use these zones to accumulate or distribute positions. Price often returns to these levels before continuing. Retail traders often miss this, but professionals use order blocks for high probability entries. Order blocks are a reflection of market supply and demand. They reveal imbalance in the market. A bullish order block shows strong buying interest. A bearish order block shows strong selling interest. These zones act as magnets for price, and they often hold as support or resistance. Now let's combine this with market structure. Price respects trend logic. It moves in waves, forming highs and lows. When price revisits an order block, it tests supply or demand. If the structure aligns, it signals a strong setup. For example, in an uptrend, a bullish order block forms. Price may retrace back to this zone. If the higher low forms there, the uptrend continues. This gives traders optimal entry with defined risk. In downtrends, bearish order blocks work the same way. Price retraces to the block, tests resistance, and continues down. Understanding this reduces false entries and increases the probability of success. Order blocks are also linked to liquidity. Liquidity is where stop losses and pending orders accumulate. Institutions hunt liquidity to execute large trades. Order blocks often align with these areas. This is why price often reacts strongly to them. Recognizing strength or weakness is key. A failed retest of an order block signals institutional strength. A breakout against the structure indicates potential trend reversal. Combining order blocks with market structure gives clarity. This is why advanced traders focus on structure plus order blocks. It's not just guessing market direction. It's reading the intentions of smart money. This approach works across Forex, indices, and crypto. For example, in XAU-USD, price often respects daily order blocks. In US30, intraday order blocks show institutional accumulation. And in crypto markets, order blocks reveal where whales operate. Risk management is still essential. Order blocks are zones, not guarantees. Set stop loss slightly beyond the block. Target the next structure level for profit. This keeps your trade safe and calculated. Timeframes matter too. Higher timeframes give stronger order blocks. Daily and 4-hour blocks hold more significance than lower ones. Lower timeframes provide precise entry points. Combine multiple timeframes for optimal results. Order blocks also show market cycles. Accumulation, manipulation, and distribution phases all leave blocks. By studying past blocks, you can anticipate future moves. Remember, market structure is the skeleton. Order blocks are the muscle. Together, they drive price. Ignoring either leads to mistakes. Some traders confuse order blocks with supply and demand zones. While related, order blocks are institutional footprints. Demand and supply zones can be smaller retail reactions. Order blocks reflect real liquidity and smart money interest. Advanced traders often mark multiple order blocks. They prioritize the strongest zones. High probability setups come from block plus structure alignment. This improves entry, exit, and risk-reward decisions. Keep an eye on false breakouts. Price may breach an order block temporarily, but if market structure aligns, it often reverses back. This is why confirmation matters. Order blocks are evergreen tools. They don't change with market trends. They work in all instruments: Forex, crypto, indices, commodities. Mastering them requires practice. Observe charts daily. Mark strong order blocks. Watch how price reacts. Compare with market structure. Over time, institutional behavior becomes predictable, and your trades become more precise, safer, and profitable. Welcome to the world of advanced trading strategy with order blocks and market structure.